All right. Hey, everyone. Welcome back for another deep dive. You know we love to get into the nitty-gritty, and today we're tackling mortgages.
Ooh, mortgages. Sounds exciting.
Well, maybe not exciting exactly, but definitely important, especially with all the recent changes and trends. We've got some fresh insights from Realtor Sean Carter to help us break it all down.
So what's got you most curious about all this?
Honestly, it's how much those mortgage rates can really impact things. Like, I was reading that even a small change in rates can make a huge difference in your monthly payments over time. And then there's all that stuff about the Federal Reserve and how their decisions can shake up the whole housing market. It's kind of mind-boggling.
It's true. It can feel like a lot to wrap your head around.
Yeah,
But that's why we're here. We're going to try to untangle it all and make it make sense.
exactly. So Sean's update mentions a bunch of different mortgage types. We've got the classic 30-year fixed rate mortgage, the 15-year fixed rate, and then those sometimes confusing adjustable rate mortgages, or AM.
Right. So the 30-year fixed rate mortgage, that's kind of like the gold standard, the most popular type of mortgage out there. You lock in a rate for 30 years and your monthly payment stays the same the whole time. Nice and predictable.
Predictable is good, right? Especially when you're trying to budget and plan for the future.
Definitely. Then you've got the 15-year fixed rate mortgage.
Mhm.
Similar idea, but you pay off the loan in 15 years instead of 30.
So I'm guessing that means higher monthly payments, but you pay less interest overall because you're paying it off faster.
You got it. And then there are those ARMs, the adjustable rate mortgages. Those can be a bit trickier to understand.
Yeah, those are the ones that make my head spin a little.
I know what you mean. Basically, with an ARM, your interest rate can change over time. So you might start with a lower rate for a set period, like 5 or 7 years, and then after that, the rate adjusts based on what's happening in the market.
So it's kind of like a gamble, right? If rates are low and it adjusts, you could be saving money. But if rates are high, well, your payments could jump up quite a bit.
Exactly. ARMs can be a good option for some people, especially if they plan to move or refinance before the rate starts to adjust. But they definitely come with more risk than those stable, predictable fixed-rate mortgages.
Okay, so ARMs are a bit of a wild card. But what about those more stable options, the fixed rate mortgages? What's making their rates bounce around so much lately?
Well, you got to remember that mortgage rates are influenced by a whole bunch of factors. It's like a giant web. And when one strand vibrates, the whole thing shakes.
Oh, web, huh? That's a pretty good visual. But let's zoom in on some of those strands. I know Sean mentions the Federal Reserve a lot. What exactly are they doing that affects my potential mortgage rate?
Oh, yes, the Fed. They have this powerful ability to influence interest rates throughout the economy. They do this to try to keep things stable, control inflation, keep unemployment low, that kind of thing.
So the Fed's like the conductor of the economic orchestra, trying to keep everything in harmony.
I like that analogy. But when they raise interest rates, like they've been doing recently, it makes it more expensive for banks to borrow money. And guess what? Those costs trickle down to us, the borrowers, in the form of higher mortgage rates.
So if the Fed keeps raising rates, does that mean my future mortgage is just going to keep getting pricier?
It's definitely a possibility, but predicting what the Fed will do is kind of like trying to predict the weather. There are a lot of factors at play.
Right, inflation. Everything seems to be getting more expensive these days. I know Sean mentioned that inflation worries are also pushing mortgage rates up.
That's because lenders want to make sure they're not losing money because of inflation. Think of it this way. Inflation eats away at the purchasing power of money over time. So if lenders don't adjust their rates, they're essentially losing money in the long run.
So they raise rates to keep up with those rising costs. Makes sense. But what I'm really curious about is how the housing market itself plays into this whole thing. Sean mentioned something about the number of houses for sale making a difference, and even the time of year.
Yeah, the housing market can definitely impact mortgage rates. It all comes down to supply and demand.
Oh, yeah, the good old economic basics.
Exactly. When there are a lot of buyers, but not many houses for sale, like we've seen in many markets lately, sellers can ask for higher prices. Lenders notice this and think, hey, borrowers are willing to pay a premium, so we can charge a bit more for those loans too.
So if I'm house hunting in a super competitive market, I might get hit with a double whammy of higher prices and higher rates.
That's unfortunately the reality sometimes. But the opposite can happen too. If there are more houses for sale than buyers, sellers might lower prices to attract offers. And that can put downward pressure on mortgage rates as well.
Okay, so it's like a constant push and pull between buyers and sellers,
Hmm.
and the lenders are adjusting rates based on who has the upper hand at any given moment. This is making a lot more sense now. But there's one thing in Sean's update that still has me totally baffled: the bond market. I just don't see the connection. What do bonds have to do with my mortgage rate? It feels like we're suddenly in a whole different financial universe.
Uh-huh. I know, it seems like a weird jump, right? But it's actually pretty fascinating. You see, most mortgages are bundled together and sold as investments called mortgage-backed securities.
Wait, so my mortgage could end up being part of some giant investment package? That's kind of wild.
It is. And these securities are traded on the bond market. And here's the key connection. If investors are really interested in buying these mortgage-backed securities, that drives up demand. And lenders can offer lower rates. They've got plenty of money to lend. But if investors are hesitant, the demand drops, and lenders might need to raise rates to attract those investors.
Wow, so my dream house could be caught up in the whims of the bond market. That's kind of mind-blowing.
It is, but that's the thing about the financial world. It's all interconnected. And honestly, it's this interconnectedness that makes it so fascinating to dive into.
I'm starting to see that. Okay, so we've got the Fed, inflation, the housing market, and even the bond market, all pulling strings behind the scenes. But how does all this actually play out for someone like me or our listeners who are trying to buy a house or refinance? I mean, what does it all actually mean for our wallets and our dreams of homeownership?
That's the million-dollar question, isn't it? And that's exactly what we'll be tackling in a part 2 of our deep dive. We'll talk about how these factors can impact your budget, your house hunt, and even your decision to refinance.
Sounds good. We'll be back after a quick break. Don't go anywhere. Okay, we're back and ready to dive even deeper into these mortgage mysteries. Last time we were talking about how all these different factors, the Fed, inflation, even the bond market, can really impact mortgage rates.
It's a lot to keep track of.
It is. So now I'm really curious about what Sean Carter sees happening with mortgage rates in the future. Does he think they're going to keep going up? Or maybe level off?
Well, Sean's update doesn't have any specific predictions, and, nobody can predict the future with 100% certainty.
Of course. Of course.
But he does highlight a few things that could have a big impact on where rates go from here.
Like what?
Well, one big one is what the Federal Reserve does next. Remember we talked about how they've been raising interest rates to fight inflation?
Yeah, they're like the economic conductors, right?
Exactly. So if they keep raising rates, that could definitely push mortgage rates higher too. But if they decide to pause or even lower rates, we might see mortgage rates stabilize or even come down a bit.
Okay, so the Fed's moves are a big wild card.
They are. And then there's the whole question of how the economy performs overall.
Right. If things slow down, people might be less likely to buy homes, which could mean less demand, lower prices.
And potentially lower mortgage rates.
Exactly.
But if the economy stays strong, the housing market might stay hot, and rates could stay high or even go up.
So it's all interconnected, just like we were saying before.
It is. It's like a giant puzzle where all the pieces affect each other.
Okay, so we've got the Fed and the overall economy to think about. Anything else?
Well, there's also the state of the housing market itself.
You mean like how many houses are for sale?
Exactly. If inventory stays low and demand stays high, that could keep upward pressure on prices and rates. But if more houses come on the market, that could ease some of that pressure.
It feels a bit like trying to predict the weather sometimes, doesn't it?
It does. You can look at the patterns and make educated guesses, but there's always a chance of a surprise storm.
Haha, that's a great analogy. So basically, we need to be prepared for anything.
Exactly. Flexibility and adaptability are key when it comes to navigating the mortgage market.
Okay, that makes sense. But even if we can't control those external forces, we can control how we react to them, right?
Absolutely. And that's one of the reasons why it's so important to have a good understanding of how mortgages work.
Right, knowledge is power.
Exactly. And the more you know, the better equipped you'll be to make informed decisions and navigate the process with confidence.
And speaking of navigating the process, I know a lot of people find it pretty overwhelming, especially if they're first-time home buyers or even those who are thinking about refinancing. It's a lot of paperwork, a lot of jargon.
It definitely can be.
Yeah.
And that's why Sean really emphasizes the importance of working with a mortgage professional.
So someone like a mortgage broker or a loan officer.
Exactly. They can help you understand the different loan options, walk you through the process, and basically be your advocate throughout the whole thing.
That sounds incredibly helpful, especially for someone like me who's not exactly fluent in financial speak. But how do you even find a good mortgage professional?
Well, word of mouth is always a good place to start. Ask friends, family, colleagues if they have any recommendations.
Right, get those personal referrals.
And you can also do some online research. Look for reviews, check their credentials, see what kind of experience they have.
So kind of like Doing your due diligence before hiring any other professional.
Exactly. You want to find someone who you feel comfortable with, someone who understands your needs, and who you trust to have your best interest at heart.
That makes a lot of sense. So once you've found a good mortgage professional, what's next? What are some of the things we need to keep in mind as we go through this process?
Well, one of the most important things is to set realistic expectations.
I think that's good advice for just about anything in life.
Haha, it is.
Yeah.
But it's especially important when it comes to buying a home. It's easy to get caught up in the excitement of it all and start picturing yourself in that dream home. You know, the one with the gourmet kitchen and the backyard oasis.
Oh, yeah, I can definitely see myself getting carried away with those online listings.
It happens. But before you start falling in love with homes that might be outside your budget, it's crucial to take a step back and really assess what you can comfortably afford.
Right. Got to stay grounded in reality.
Exactly. And remember, your mortgage payment is just one piece of the puzzle. You also need to factor in property taxes, homeowners insurance, utilities, maintenance, and all those other fun expenses that come with owning a home.
Oh, yeah, those fun expenses.
It's easy to forget about those when you're caught up in the excitement of buying a home, but trust me, they can add up quickly.
So it's all about finding that sweet spot between your dreams and your budget.
Exactly. And once you have a realistic budget in mind, that's when you can start shopping around for the best mortgage rates and terms.
That's where those multiple quotes come in handy, right?
Exactly. Don't be afraid to shop around and compare offers from different lenders.
It's kind of like finding the best deal on a flight or a hotel, except with way more zeros involved.
Haha, good analogy. And remember, you can always try to negotiate with lenders too. They are businesses, after all, and they want your business.
Really? I always thought mortgage rates were pretty much set in stone.
Not at all. They can definitely be flexible, especially if you come prepared.
Okay, so how do you actually negotiate with a lender?
Well, be organized, have all your financial documents in order, and be prepared to explain your situation and your needs.
So basically, the more prepared you are, the better position you'll be in to negotiate.
Exactly. And while you're at it, make sure you read all those loan documents carefully.
Ugh, the fine print.
I know, I know. It's not the most exciting reading material, but it's important to understand everything you're agreeing to before you sign on the dotted line.
You don't want any nasty surprises lurking in there.
Exactly. Okay, so we've talked about finding a mortgage professional, setting realistic expectations, shopping around, and reading the fine print. Anything else we need to remember as we navigate this mortgage maze?
I think the biggest takeaway for me is that knowledge is power. The more we understand about how mortgages work, the better equipped we'll be to make smart decisions.
Absolutely. And even if you're not planning to buy a home or refinance right this second, this information is still valuable. It's like building a financial toolkit that you can access whenever you need it.
That's a great way to think about it.
And remember, even though we've covered a lot of ground today, this is really just the beginning of the conversation. There's so much more to explore.
That's right. So if you're feeling inspired to dive even deeper, make sure to check out part 3 of our deep dive, where we'll be talking about welcome back, deep divers. I hope you've got your scuba gear ready because we're going even deeper into the mortgage ocean in this final part.
Uh-huh. I love that analogy. It's true, though. We've covered a lot of ground in parts 1 and 2. But now it's time to really get practical and talk about how to apply all this knowledge to your own situation.
Exactly. It's all well and good to understand the big picture and all the factors that can influence mortgage rates, but at the end of the day, what really matters is how it all plays out for you, the individual borrower.
I couldn't agree more. So let's get down to brass tacks. One of the most important things to remember as you start this process is to set realistic expectations.
Oh, expectations. Those can be dangerous, can't they? Especially when you're dealing with something as emotionally charged as buying a home.
They really can. It's so easy to get swept up in the excitement, to start picturing yourself in that dream home, hosting dinner parties in the gourmet kitchen, relaxing in the spa-like bathroom.
Yeah, those online listings can be pretty tempting. Suddenly you're living the good life, even though you haven't even started the pre-approval process.
Exactly. And that's why it's crucial to take a step back and really assess what you can comfortably afford. It's not just about qualifying for a certain loan amount. It's about finding a home and a mortgage that fit into your overall financial picture.
Right. It's got to be sustainable. You don't want to be house poor, struggling to make those monthly payments and missing out on all the other joys of life.
Exactly. And remember, your mortgage payment is just one piece of the puzzle. You've also got property taxes, homeowners insurance, utilities, maintenance. It all adds up.
Oh, yeah, don't forget those unexpected repairs, like when the furnace decides to quit in the dead of winter or the roof starts leaking.
Ugh, those are never fun surprises. So be honest with yourself about what you can truly handle, both monthly and in the long run. It's much better to be pleasantly surprised by how much you can afford than to be stressed out and struggling to keep up.
Okay, so let's say we've done our homework, we've set a realistic budget, we've got our finances in order. What's next?
Well, once you have a clear idea of what you can afford, it's time to start talking to lenders. And this is where that advice about shopping around really comes in handy.
Right, don't just go with the first lender you come across or the one your realtor recommends.
Exactly. Gather quotes from multiple lenders and compare them side by side. Look at interest rates, fees, loan terms, the whole 9 yards. You might be surprised by how much they can vary.
It's like finding the best deal on a flight or a hotel, except with way more zeros involved.
Uh-huh, exactly. And don't be afraid to negotiate with lenders, too. They're businesses, after all, and they want your business.
Wait, really? I always thought mortgage rates were pretty much set in stone.
Not necessarily. They can definitely be flexible, especially if you've got good credit and a solid financial profile.
So how do you actually go about negotiating with a lender? Do you just show up with your best poker face and start haggling?
Haha. Well, a friendly and professional approach is always a good idea. But the most important thing is to be prepared. Have all your financial documents in order, your credit report, income verification, bank statements, so you can present yourself as a strong and organized borrower.
So basically, the more organized you are, the better position you'll be in to negotiate. Makes sense. Lenders probably love working with people who have their act together.
They absolutely do. And while you're at it, make sure you read all those loan documents carefully. I know it's tempting to just skim through them, but it's crucial to understand every term and condition before you sign on the dotted line.
Yeah, I've been guilty of that myself. Those legal documents can be pretty intimidating, but I guess it's better to ask a million dumb questions up front than to regret it later.
Couldn't agree more. And remember, even after you've signed those papers and closed on your mortgage, your journey isn't over. Owning a home is a long-term commitment, and it's important to manage your finances responsibly.
Right. It's not just about getting the keys and popping the champagne. It's about creating a sustainable financial future for yourself and your family.
Exactly. Stay informed about market trends, keep an eye on your budget, and don't hesitate to reach out for help if you need it. There are resources available, and you don't have to navigate this alone.
This has been such an insightful deep dive. I feel like we've gone from feeling completely lost in the mortgage maze to actually having a roadmap and a compass to guide us.
That's what we were hoping for. Remember, you don't need to be a financial expert to make smart mortgage decisions. Just stay curious, informed, and don't be afraid to ask questions. And most importantly, don't let the process overwhelm you. Take it one step at a time, and remember that buying a home can be an incredibly rewarding experience.
Well said. And to our amazing listeners, thank you so much for joining us on this deep dive into the world of mortgages. We hope you found it valuable and empowering. Remember, whether you're buying your first home, refinancing, or just dreaming about the future, knowledge is your best tool. So stay curious, stay informed, and happy house hunting.